Assalamualaikum warahmatullahi wabarakatuh and very good evening to all. So here I will continue with the second subtopics under chapter 1, which is qualitative characteristics of useful financial information. Hope all of you still excited and in a good mood even we have certain technical error. So let's start and learn together. But before we begin further, as before, I have introduced it. We're still in the same group with the same members. We're still in the same group with the same members, which are Acap, me, and Saleh. So now, started with the conceptual framework. The ISB's conceptual framework for financial reporting describe the basic concept by which financial statements are prepared. The main purpose of the framework is to first assist in the development of future IFRS and the review of existing standards by setting out the underlying concept. Second purpose is to promote harmonization of accounting regulation and standards by reducing the number of permitted alternative accounting treatments. Lastly, the purpose of this conceptual framework is to assist the preparers of financial statements in the application of IFRS, which will include dealing with accounting transactions for which there is not yet an accounting standard. So basically, these are the main and basic purpose for this conceptual framework. So next slide. After that is qualitative characteristics of financial information. The revised framework distinguishes between two types of qualitative characteristics that are necessary to provide useful financial information, which are first, fundamental qualitative characteristic, and second is enhancing qualitative characteristic. So I will continue. So here we can see that under FQC, it has two sub which are relevance and faithful representation. And for EQC, we have comparability, timeliness, verifiability, and understandability. Okay, so this chapter will distinguish between the fundamental qualitative characteristics that are the most critical and the enhancing qualitative characteristics that are less critical but still highly desirable. So now let's move to the fundamental qualitative characteristics first and discuss about relevance and faithful representation. So the first point under relevance, which is influence economic decisions of user. This is where the relevant financial information is capable of making a difference in the decisions made by users, and it is also has to be predictive value and confirmatory value, or both, where relevant information assists in the predictive ability of financial statement. So for the fundamental qualitative characteristic, we will discuss about the relevance and faithful representation as the characteristic. So the first point under influence economic decisions of user. This is where the relevant financial information is capable of making a difference in the decisions made by users, and it is also has to be predictive value or confirmatory value, or both, where relevant information assists in the predictive ability of financial statement. That is not to say that the financial statement should be predictive in the sense of forecast, but that past information should be presented in a manner that assists users to assess an entity's ability to take advantage of opportunities and react to adverse situations. So the next point is materiality, where it is their whole or cut-off point for information whose omission or misstatement could influence the economic decisions of users taken on the basis of the financial statement. This will depend on the size of the item or error judged in the particular circumstance of its omission or misstatement. Hence, the materiality is not a matter to be considered by standard setters, but by preparers and their auditors. Second is the faithful representation, where general purpose financial reports represent economic phenomena in words and numbers. To be useful, financial information must not only be relevant, it must also represent faithfully the phenomena it purports to represent. Financial statements will generally show a fair presentation when first they conform to accounting standards, second, they conform to any relevant legal requirements, and third, they have applied the qualitative characteristics from the framework. As I understand, conform is where we comply with the rules of the accounting standards. Same too, we comply with the rules that related to any relevant legal requirements. So, I will continue. The financial information that faithfully represents economic phenomena has three characteristics, which are complete, and it is neutral, and also it is free from error. So for the materiality, it is actually cut-off point for information whose the misstatement could influence the economic decisions of users taken on the basis of the financial statement. So this issue will depend on the size of the item or error that will be judged in the particular circumstance of its misstatement. So the materiality is not a matter to be considered by standard setters, but will be considered by the preparers and the auditors. Okay, so proceed further to the second big point, which is the enhancing qualitative characteristic. So the comparability, verifiability, timeliness, and understandability are directed to enhance both relevant and faithfully represented financial information. So those characteristics should be maximized both individually and in combination. So first, for comparability, users can identify similarities and differences by doing the comparability is fundamental to assessing the performance of an entity by using its financial statements. Assessing the performance of an entity over time or the trend analysis requires that the financial statement used have been prepared on a comparable basis. Besides, consistent application of method can exist when comparability is enhanced by the use and disclosure of consistent accounting policies. So here, users can confirm that comparative information for calculating trend is comparable. The disclosure of accounting policies also at least inform users if there is different entities use the different policies. The comparability should also be distinguished from consistent, that the consistent use of accounting method. It is recognized that there are certain situations where it is necessary to adopt new accounting policy, usually such as through the new standards, if they enhance relevance and reliability. Consistency and comparability require the existence and disclosure of accounting policy. So next is verifiability. So under verifiability, financial information is verifiable when it enables knowledgeable and independent observers to reach a consensus on whether a particular depiction of an event or transaction is a faithful representation. Verifiability also helps to assure that the users of the information represents faithfully what it purports to represent. Financial information is supported by evidence, and independent individuals can check them to see whether such information is faithfully represented. In other words, this information is verifiable if it can be audited. The third one is timeliness. Timeliness means that information is available to decision makers in time to be capable of influencing their decision. It shouldn't be significantly delayed or else it will be of little or no value. So lastly, the understandability. Understandability requires financial information to be understandable or comprehensible to users with reasonable knowledge of business and economic activities. To be understandable, information should be presented with classified, characterized with clearly and concisely. However, it is improper to exclude complex items just to make the report simple and understandable because it may be too complex and cannot be made easy to understand. Okay. Although the qualitative characteristics have helped the financial information be more useful to the users, it also has some constraints. So, one is timeliness. If there in an expected publication in reporting the financial information of an entity, then the information itself may not be relevant or reliable for the users. So another constraint is the balance between the benefits and the costs. The benefit of qualitative characteristics should outweigh the cost of obtaining them. If if costs are more than the benefits, then an entity may decide not to provide the qualitative characteristics which are difficult to obtain. Another constraint is the balance between the characteristics themselves. In some cases, a conflict may happen between the characteristic. Therefore, a trade-off may happen to allow the objective of the financial statement to be met. And the final constraint is a true and fair view of fair presentation. The framework for the preparation and presentation of the financial statement does not mention how an entity should present the characteristic fairly. Lastly is the constraint on qualitative characteristic. Um, for this, cost is a pervasive constraint to financial reporting. Reporting such information imposes costs, and those costs should be justified by the benefit of reporting that information. The ISB assesses costs and benefit in relation to financial reporting generally and not solely in relation to individual reporting entities. The ISB will consider whether different sizes of entities and other factors justify different reporting requirements in certain situations. So that was the explanation of qualitative characteristic of financial information. Thank you for listening and don't forget to subscribe